Welcome and thank you for joining us for today's webinar, Working Capital, 3 Strategies to Free Up Cash and Manage Suppliers, brought to you by IOFM and sponsored by PRGX. We have a few housekeeping notes to go over before we get started. If you have any technical questions or issues using the WebEx platform, please use the chat box and I will respond right away. If you have any issues with audio, please click on the phone icon above the chat window to receive the teleconference information. For those that do call in, to ensure call quality, everyone's lines have been muted. If you happen to get disconnected, you can log on again using the instructions provided in your webinar confirmation email. If you continue to experience difficulty, please email webinars@iofm.com and we will respond as soon as we can. We encourage you to ask questions throughout the presentation. Please type your questions into the chat box and hit send to submit them. At the end of the presentation, we will have our presenter answer these questions. We will also have 5 polling questions during the webinar. A pop-up box will appear when we run each poll. Please choose from the multiple choice answers and hit submit. We'd love to have your participation and insight. And finally, this webinar will be recorded and you'll receive a thank you email with the on-demand materials within 2 business days. With that out of the way, I would like to introduce our speakers for today. First, we'll have Mark Brousseau, President of Brousseau and Associates. Over the past 26 years, Mark has established himself as a thought leader on accounts payable, accounts receivable, payments, and document automation. Popular speaker at industry conferences and on webinars and podcasts, Mark advises prominent end users and solutions and service providers on how to use automation to improve document and payment-driven business processes. Mark has chaired numerous educational conferences and has served on several industry committees and boards. He resides in Center City, Philadelphia with his wife and 3 sons. We'll also hear from Adam Moore, VP of Analytics at PRGX. Adam has over 20 years of experience with over 10 years in consulting and 10 years in recovery audit. Adam's expertise includes supporting global clients with payment analytics projects, working capital initiatives, as well as M&A engagements. At this time, I would like to welcome our speakers and hand the webinar off to Mark.
Thank you so much, Jovi, and thank you all for joining us today. The combination of rising interest rates, sky-high inflation, an unpredictable supply chain, and a tight labor market have created tremendous cash flow concerns for businesses. I'll leave it to pundits to argue about whether we're in for a soft landing, a hard landing, or just the status quo. But the thing is that finance departments need to be ready for anything. Finding ways to liberate capital on existing revenues is going to be critical. And that's what we're going to discuss during today's webinar. We'll talk about working capital concerns of businesses, provide you with the latest insights on what's happening with working capital, and show you proven strategies for capturing working capital by leveraging your data. But before we do any of that, we wanted to give Adam a chance to tell you a little more about the sponsor of today's webinar, PRGX. Adam, welcome aboard.
Thank you. Thank you. Just wanted to give a quick overview of who PRGX is, and some of you may be familiar with us for working with us in the past or currently, but who we are. We are a global leader in source-to-pay analytics. We utilize analytics to help us aggregate data and find value through that data for our clients. So some of the ways that we find value is, one, through our recovery audit practice, where we assess all of the transactions between our client and their suppliers to recover hard dollar savings. So as we do that on an annual basis, we're recovering over $1.4 million for our clients. Kind of narrowing down to the grocery sector as an example, we work and find over $450 million for our grocery clients, and in our retail practice, we really get granular into some of the complex data around promotional funding and the activity around that to unlock some of those savings. For our non-retail clients, we support all industries from insurance, banking, media, pharmaceuticals, oil and gas, and manufacturing, doing the transactional audit work and also contract compliance and analytics. The same data that we use to help recover the audit findings is what we use to support our analytics practice. And so we use that, accounts payable data, all of the inventory data and so forth that we get from our clients to really help, give them the analytics and KPIs that they need to manage their business and identify opportunities to bring in either more working capital opportunities or more profitable opportunities in the way they manage their business. Our reporting is designed to be customizable to our clients' needs. And so we work with our clients to bring those insights that they need to run their business and really support specific initiatives that they have within their organization, such as working capital improvement that we'll discuss today.
Thank you so much, Adam. We look forward to hearing your insights during today's webinar. We thought we'd start with a level set, a poll question, which is about to be displayed on your screen. We want to know, how has the importance of generating additional working capital changed for your organization compared to 3 years ago? How has the importance of generating additional working capital changed for your organization compared to 3 years ago? Would you say it's significantly more important? Would you say that generating additional working capital is slightly more important compared to 3 years ago? Would you say it's unchanged? Would you say that generating additional working capital is slightly less important compared to 3 years ago? Or would you say it's significantly less important? Take a moment to respond to the poll question now displayed on your screen, and we'll discuss the results in just a moment. So Adam, when you're talking to finance leaders, what are they telling you they're thinking about these uncertain economic times these days?
Yeah, I think, coming, out of 2020 with, some of the pandemic, and we had, issues with supply chain and everything that goes along with that. That was like the main, center of focus during that 2021 and 2020 period. So the shift is there now into, inflation, as you were talking about before. And so as, inflation is coming into the mix, like how do we, change the way we operate our business, and where do we need to apply our focus to really ensure that we're keeping up with where we need to be in the industry and in the market to, be profitable and have that cash available to really support the business.
Adam, it might be tempting to some of the finance leaders on the phone today to think that, well, we survived the tumult of the pandemic. Surely we can get through a recession, but that's not true at all. I mean, a recession is a much different animal than what we experienced during the pandemic, no?
Yeah, and I think when we see there's kind of that recession on the outlook, and then the combination of the inflation and just what's driving consumer behavior and other demand factors, I think that's where we see a lot of changes. Is we may see changes in some of the demand, but then the cost of those products have been much higher across certain industries, and so how do we account for that and manage the business with all those factors coming into play.
Are you finding that many finance leaders are already taking steps to prepare for the possibility of a recession?
Yeah, there's various steps, and again, there's still a lot of competing factors depending on what specific industry somebody is in. But yeah, I think a lot of them are evaluating where is their cash, and do they have the cash and the accessibility to that cash to really be healthy as we go through any downturn in the economy.
We asked our attendees, how has the importance of generating additional working capital changed for your organization compared to 3 years ago? Look at this. 83% of our attendees today say that generating additional working capital is more important to their organization today than it was 3 years ago. 46% of our attendees say that generating additional working capital is slightly more important compared to 3 years ago. 37% of our attendees say it's significantly more important. Does this surprise you, Adam?
No, it's really in line with what we hear from our clients every day, and from whether it's the cash we help them generate with the recovery audit business, or the cash we generate with some of the analytical insights around working capital. Like we see where this does align with the overall market.
You know what, Adam? They did such a great job with the poll question. Let's do one more. This time we want to know, which of the following is your biggest pain point in managing your organization's working capital? Which of the following is your biggest pain point in managing your organization's working capital? Is it incomplete information? Is it inaccurate data? Is it outdated information? Is it complicated reporting tools? Is it fragmented systems, or is it something else? Take a moment to respond to the poll question now displayed on your screen, and we'll discuss the results in just a moment. Adam, it's been a long time since we've had a true recession in this country. I'm obviously putting aside the economic tumult of the pandemic for a moment here, but I'm curious, do you think that most finance departments have the tools they need to adequately manage their working capital in an economic downturn?
From our experience, I would say it's kind of 50-50, like half of them do and half of them don't. But then, what the challenge becomes, even when they do have, the tools in place to help, measure performance, they have complex organizations where you might have, multiple ERP systems at play, or you might have, multiple regions. And sometimes getting that information consolidated in an easy, accessible, location is really challenging for them. And even something that we'll look at later is just what is our true relationship with a supplier, from a matter of, do we have 5 different accounts payable IDs in the system for the same supplier? And so sometimes bringing that information together is where we see a lot of market challenges, even if they have an analytic solution in place.
Adam, we don't often think about our data quality as being critical to managing our working capital. And yet, even as our poll results suggest, it really does make a big difference in our ability to adequately manage our cash. Lost on many finance leaders, or is it just that they have too many other priorities to actually go about cleaning up their data quality?
Yeah, I think it's a lot of times the data is there, and then the quality may come down to is it accessibility that's driving some of the quality, or is it just the way that the solution has been built? And a lot of these systems are very unique to the specific organization and how they operate. And so if you try to do a plug and play system off the shelf, like, you might not get the results that you're really looking for, because those calculations haven't been customized to how you operate your business. And I think that's something that where we do see sometimes, like, either homegrown solutions or really kind of taking a lot of market presence, because those are customized to the specific need of the business, versus some off the shelf solutions that are not really adaptable to individual business needs.
Yeah, and to that point, I reckon there's somebody in the audience right now, Adam, who's shaking their head in a disapproving way, thinking to themselves, oh, come on, Mark and Adam. My ERP can give me everything I need to manage my working capital. What's the fallacy in that thinking?
Like, the information is there, but it's just maybe not in a consumable view. And that's where, like, as we get into, whether it's a retailer or a CPG or a manufacturing company, like, there's just a lot of data there. And so, these ERP systems are really, focused more on, processing the data to ensure that you make the payment. They're not as focused on, giving you the KPIs and feedback in the, easiest to use manner. And so that's where I think, having, that right solution and the right visibility into that data, it really helps, put a different picture on what's actually happening with your performance from that data.
We asked our attendees, which of the following is your biggest pain point in managing your organization's working capital? 24% of our attendees said that fragmented systems is their biggest pain point in managing their organization's working capital. 20% said incomplete information. 13% said complicated reporting. 11% identified inaccurate data, and 7% said outdated information. 1/4 of our attendees said there's something else that's making it difficult for their organization to manage their working capital. But when I look at these results, Adam, it's clear fragmented systems and fragmented data are making it difficult for organizations to get a true picture of their company's cash flow. Does this surprise you?
No, this is really in line with what we see, and even in our merchandise practice, like we get sales data, accounts payable data, and funding data, and all of these systems are really disparate in those environments, and bringing that data together, and even from a working capital standpoint, you might have your accounts payable data in one location, but then your accounts receivable is in a different instance of that system, and your inventory is in another system. So you're really bringing all that data together in one viewable dashboard can be very complex when it's broken down in various systems.
No matter what's making it hard for you to manage your company's working capital, the strategies that Adam's going to share with you today will help you avoid a potential cash crunch. Adam?
Yeah, thank you. So we wanted to just start with kind of an overview of working capital, and really what are some of the key influencing factors as we get into this. So on this slide, what we're looking at is really the core ingredients of working capital. And so we have like our days inventory on hand. So as whether we're a manufacturing company or if we're a retailer, like inventory is a key part of our business to either be able to provide the product to our customers or to be able to produce the product to sell to our customers. So inventory becomes like a very key component in this process. And then we have our days sales outstanding, which is how long does it take us to collect payment from our customers and our clients. And so that really is associated with our accounts payable, our accounts receivable side of the business. And then we have our days payable outstanding that helps us really focus on how long is it taking us to pay our suppliers? Like what is our payment term with our supplier? What is our payment process with our system to allow us to pay our suppliers? And so when you bring these three ingredients together, it really creates what a lot of us are familiar with is our cash conversion cycle. And as we look at a cash conversion cycle, like we really want to be able to make that as low of a number as we possibly can, because it really tells us how much time do we have our cash tied up in accounts receivable and inventory. And so it's really a key metric to evaluating working capital and measuring that performance to see where you stand in the market and what opportunity you have to change the performance with that. And as we look at that simple calculation of just days inventory outstanding plus days sales outstanding minus the days payable outstanding, it does seem like a simple calculation, but within an organization, there's just so much complexity when you're managing that working capital due to the number of departments that touch each of these individual measures that it's really hard to get consensus on how do we properly manage this process to make sure we're meeting all our demands as far as client demands and customer demands, and then also evaluating the efficiencies of our business to extend our working capital without risking out of stocks as an example. So we'll talk a little bit more about this as we go through the next slide here. So on this slide, we start to talk about like why is the working capital important. So as we discussed on the cash conversion cycle, the shorter the cycle, the less time we have our money and our cash tied up in that process. So when there's gains in working capital, like we could really start to fuel other strategic initiatives in our organization. So on this slide, we kind of outlined a couple of those examples of where we could use that cash to really drive that business and create better health for our overall business. So on the investment side of it, it's key for all organizations to compete with their competitors and gain efficiencies to really be able to go to market with the best product and service. And so having those investments in the business from IT infrastructure to supply chain to customer service is really a key element to where we want to be able to invest cash into those initiatives to really drive our overall performance. On the growth side of it, or sorry, on the growth side of it, on the previous slide, we have, other areas as far as like we need to invest in R&D and we need to, expand our footprint, and, having accessibility to cash is, really something that allows organizations to, best, fuel that growth into the future. And then lastly, we have like reducing financial stress and, rewarding our stakeholders. And, these are just areas that, we could, really, generate better health in our business, whether it's from, our business's, financial position with, loans and debt, or is it, with our, front end, like our investors and our employees, and really, creating better health for our organization in those ways. Okay. On this slide, there's a lot of different levers that we could manage to manipulate our working capital performance. However, one of the challenges is that these levers are connected to many different functional areas within our organization, and sometimes it's difficult to get organizational alignment to take the actions to improve the working capital. So in our experience, there are 5 core elements that an organization can strategize around to connect these disparate teams and get them aligned on improving the organization's working capital position. So going through these quickly, on vision, if all of the operational functions are not aligned on making a change, it will limit the success of the initiative. We find the best-in-class organizations, when they're going out to improve their working capital, really start the process from the top down and have that organizational goal set from the top to really help align all those cross-functional departments to focus on that initiative in unison, and everybody's kind of marching towards the same goal with that vision from the top. From value, where does the opportunity exist, and what is our ability to capture it? It's easy to say, let's extend all our payment terms, but in reality, it's much more difficult to do that in mass and say we're going to extend our payment terms across all our clients. Like, we know that that's not an easy thing to do, and we really need to have that data available to create the value and pinpoint where that value exists. From accountability, how has that working capital evolved over previous years? Has there been system changes that may have impacted our working capital position? Do we have the right ownership of the KPIs across the organization to really evaluate what actions we need to take to manage the business and capture that opportunity? From service, we can't just run out to our strategic partners and tell them that we need 120-day payment terms. We have to be thoughtful in our process to ensure that we are not disrupting our business. Also, we know better now, like how we're paying our suppliers. So like we need to know like what is our current performance and how are we paying suppliers before we go out there and start making these asks in a negotiation. Like we've seen clients where they may have a 30-day payment term with a supplier, and then they go to blindly negotiate with that supplier to come to find out that they're already paying in 60 days and 30 days late. So it just kind of throws off the dynamic of that conversation when you don't have like the key performance elements in hand to really support how you're going to go to market. Lastly, efficiency is what can be done within our process currently to improve our working capital position without having to negotiate. We see when we evaluate processes that sometimes the opportunity is in our own control and we don't need to go out to the market with our suppliers to negotiate. We could just make some easy adjustments on our own process to capture some of that working capital opportunity. So one of the things that or I think did we skip a slide? Sorry. Okay. No, we're good. Sorry. So one of the things that we do as we go through this is when we support our clients, we look at some of the external data to help them set these strategies. So one of our suggested steps is when an organization is seeking to improve their working capital is to evaluate what's going on in the market. So here we have a lot of companies going out, and we see, like in the industry, we might see letters that, hey, a company's asking for 100-day payment terms. But in reality, are they really achieving that ask across all of their suppliers? Or is it just happening on some of their non-strategic tail suppliers? So we help our clients look at that external performance to help them set the goals and measure that goal against the industry. In this slide, we brought together some high-level views of day sales outstanding, and we could see, across 4 different, industries that we have a lot of different performance, over time here. So in retail and technology, we see that like that day sales outstanding is mostly flat. However, when we look at the consumer packaged and manufacturing side of it, in those industries, we're seeing that there have been some variations across, the sample, and we see that, there might be opportunities if we fit into one of those, categories versus, one of the other categories that doesn't have as much movement. So, as we, go through this, like there's a couple different ways of, looking at it. One, if I'm a consumer packaged good company, I could kind of measure my day sales outstanding performance to some of these market performers and see where do I fit in, and do I have an opportunity? And likewise, if I'm a retailer and my suppliers are mostly consumer packaged goods, I could also leverage that information to give me some insights as far as, are my competitors gaining significant payment terms with these core suppliers, and how is my payment term connected to their day sales outstanding, which would indicate how other retailers may be paying them. So we can start to bring in some of this information to really help drive what is our opportunity and how do we compare to the market. On this one, we've done the same thing with the days payable outstanding, and so we're able to kind of look at how, if we're looking at the consumer packaged goods as an example, how are the consumer packaged good industry leaders gaining payment terms with their suppliers through their days payable outstanding KPI. And so we could see that there is some slight upward movement across the board on all of these. So we could see that there has been a pretty big strategic initiative in that industry to go after their suppliers and gain some working capital with extended payment terms. However, on the retail side of it, we could see that it's a little bit flatter. There's not as much industry-wide growth on the days payable outstanding on the retail side, which indicates that they're not gaining some of that track suppliers. And then as we look at technology and manufacturing, we do see a lot of flatness in technology, but there are some spikes that may be out there based on specific industry leaders out there.
That brings us to our third poll question, which is about to be displayed on your screen. We want to know, which of the following working capital levers is currently most important to your organization? Which of the following working capital levers is currently most important to your organization? Days payable outstanding, days sales outstanding, days inventory outstanding, or are they all equally important to your organization? Take a moment to respond to the poll question now displayed on your screen, and we'll discuss the results in just a moment. So we know, Adam, that when a recession appears to be imminent, one of the first things that businesses do is start to try and stretch out those payment terms. Are you seeing that already occurring in the finance departments you're talking to? And is that really the best strategy?
Yeah, I think we see the want and the desire to extend payment terms, but in reality, if you want to extend payment terms, that means you're taking cash away essentially from your suppliers. So it is definitely something that everybody wants, but then the realistic opportunity of capturing it is not as easy as it sounds, right? And so I think that's where we see that in our finance departments that we work with, is that everybody wants to extend that payment term, but as a lot of people on this call probably know, when you engage with the supplier and start that conversation, it's not an easy conversation to have, and there's a lot of tug of war essentially between the two people at the negotiating table to see who's going to get the extended payment term and who's not. And so that's where we see a lot of challenge in the industry there.
So then are all of these levers equally important into working capital mix, in your opinion?
Yeah, I think they all are all equally important, and it just depends on like the industry and which one is most relevant. So in some industries where you're not selling a specific product, the inventory might be less important because you don't have inventory to really manage, versus like if you're a retailer, you have a lot more inventory in your store because you have to stock the shelf to be able to meet your customers' demand. So when you look at it, the days payable outstanding and the days sales outstanding is really applicable to all, with inventory being less applicable to some industries.
We asked our attendees which of the following working capital levers is currently most important to your organization. 38% of our attendees said days payable outstanding is the most important working capital lever to their organization. 18% identified days sales outstanding as the most important working capital lever. 2% identified days inventory outstanding. 43% of our attendees, Adam, all of these levers are of equal importance. So the question becomes, how can we go about improving our working capital? And to tell us about that, I'm going to hand it back to Adam.
Yep. Yeah. So in the next couple slides, I think as the title of the webinar demonstrated, like we wanted to cover like 3 topics here that can help organizations capture working capital and some of the opportunities that exist. So the first one that we wanted to cover off is monitoring current performance. So we think this is it sounds very basic and very fundamental, but it is really the starting point and that foundation of identifying where that working capital opportunity exists. And it really starts with looking at that current performance and how are we paying suppliers today, and what is the mix of payment terms we have across our spend. And so that's something that we help clients in our analytics build out and really give them those dashboards that may not exist in some of the ERP systems to help identify some of these KPIs. So the first one is just simply days to pay. Like based on all our payables, what is our days to pay currently? So like in this example, like we would look at it and say, okay, based on the weighted average of the spend and the days it took to pay, our days to pay might be 21.5 days. So that really sets the baseline of where we're at currently and where can we go. And then there's a number of different ways that we'll discuss of how you can evaluate that. Process is very important. Like we've seen a lot of organizations change ERP systems over the years, like whether they're going into a SAP or Oracle from an older existing legacy system. How has that performance changed as they've made that transition? And so this is an example of looking and evaluating that process, is having that historic view, because you might look at your process and see that, well, last year our days to pay was 22.79 days. How did we lose that day and a quarter from this year's performance? And really having that accessibility to the data to really drill into it and see, what's a specific category or a specific supplier that really, drove that, or was it across the board and our performance from our process just changed? Next, we have like wrong terms. Like, when we bring this into the system, we could really start, comparing, how did we pay against the terms that we have, and do our systems from the invoice to the vendor master data to the receivables data, do we have the right term in the system that we're paying against? And we could evaluate that and look at what should our days to pay be based on the terms that we have, and really compare that to that performance to see, are we paying too early in some cases or too late in other cases against the term we have today? And if we are, what is the root cause of that? And then that takes us lastly into that early and late payment to really help quantify what are we paying early and late and why, and is it something that we could prevent from an early payment standpoint, and from a late payment, can we help minimize that so we're not disrupting our suppliers and causing unneeded correspondence and communication with our supplier community. Next piece is just leveraging internal insights. There's, as we get into some of these, big organizations, there's just so much data that is out there. And are we leveraging that data to really identify what our opportunity is? And so, one thing on the left-hand side of the slide here, one of the things that we help our clients do is classify that data so they could really look at that data from a specific spend category, whether it's on the goods not for resale side of the business or the goods for resale. We could help our clients identify where are we spending the money, and then when we get into a specific category of spend, we could analyze our payment performance within that category. In this case, we have marketing. We could see what is our distribution of payment within that category. Are we paying 30 days for some suppliers and 60 and 90 days for another? And is there an opportunity for us to set a category target to really help harmonize within a category and set a target and a goal for a specific category based on leveraging all that information that we have within a category? The other opportunity is looking at days of inventory on hand and really looking at that days of inventory to like our payment term. Are we holding our inventory longer than we are, have an opportunity to pay for it? So like, in this example, if we have 65 days of inventory and then 30 days of payment terms, we're paying for that product before we've had an opportunity to sell it and collect the cash. So that becomes like a really important ingredient in that mix to really evaluate our payment term against a real fact-based piece of information that we could leverage as we talk to a supplier. Another opportunity is just parent-child harmonization and looking across some of these big organizations and seeing how many different vendor IDs or vendor names that do we have that roll up to IBM as an example, or Newell Brands. Some of these larger organizations that have so many different operating divisions, we could help bring that information together and see that, hey, we have 6 different subsidiaries of IBM and we have 6 different payment terms for those subsidiaries. Is there an opportunity to harmonize that based on bringing that information together and really pulling that into view of an end user? And then lastly, as we mentioned before in the poll, system harmonization. Like a lot of times, like we have, whether it's through the M&A process that organizations go through, we get a number of different systems that we may be running from. We might have one system for a region in Canada and then another operating system for a region in the US. And as we start looking at that distinct supplier across the 2 different systems, do we have the same payment term? Or is there an opportunity for us to leverage the payment term we've already negotiated, in this case of 45 days, and harmonize that across the 2 different systems? The third one is really using the external insights, and we've covered off on a couple of these as we looked at the DSO and DPO from a market perspective. But as we go to a supplier and we look to negotiate on some of our strategic suppliers, whether it's a CPG or a manufacturing partner or just a raw material provider, like some of these big companies, we could really leverage some of the information that is publicly available to capture their DSO performance and their DPO performance. So when we look at their DSO, it really kind of gives us an indicator of how are other companies and customers paying that supplier. So if we looked at in this example, this company has a 23-day DSO. So that would be an indicator that a lot of customers of theirs are paying on average at 23 days. So we could kind of leverage that information and compare that to our payment term and see, is there an opportunity there? So in this case, if our payment term was 10 days, as an example, we would look at that comparison and see that, hey, it looks like there could be an opportunity with this supplier, because we could see that, in aggregate, across all their, customer base, their day sales outstanding is 23 days. So we might have an opportunity to push that supplier to get towards that average. And then as we look at, that supplier's days payable outstanding, we could really start to see the trend line and see, are they gaining leverage from their supplier? And are they including or improving their cash chain position versus us, and are they sharing some of that benefit with us? So in this example, like we kind of see where, it's small, but we could see that they went from around 45 days to 68 days on their days payable outstanding. So they gained approximately 20 days on their side of it, but have they shared any of that benefit with us as, their customer? And so we could utilize that information to really, set up, targets and, really, kind of quantify how realistic is the opportunity to capture with that supplier. Next, we have benchmarking. Benchmarking is something that, there's, a number of providers in the industry that, provide, benchmarking services, but really using that benchmarking is, ideal for a couple different areas. One, around a category and looking at a category of spend, whether it's, goods for resale or goods not for resale, and really seeing, what is normal in that category. So we talked about marketing before, what's, normal in the industry for a payment term in marketing. And then as we, get, a little bit more narrow and we look at, for example, like a CPG, it's like, what do other customers of that CPG have, for their payment term? And so we kind of see like a visual on the left here saying like, okay, these are the payment terms that exist in the market. And this is kind of the weighted average of, 34 days. So then, again, we could start utilizing that information and, measure that against our own term and see, is it realistic for us to go out there and get incremental payment terms on that supplier? So in this case, if we were at 35 days, like we would say the likelihood of us gaining would be, on the lower end with this supplier, even though there's a couple, that might be closer to 60 days. But, it's something that we could bring into that process and that fact base to really help us identify, the opportunity. And then lastly, as we, mentioned there, one more was just, that peer comparison that, we talked about. Like when we look at our industry, is what is the trend in our industry? Is our industry gaining, payment terms, across the board? And, can we see that, with their DPO performance and really help, setting, the stage of what the opportunity really is? Because again, like we've seen, these letters out there with, some of these, companies going out and getting 90 and 100-day payment terms. And we could leverage some of this information that is publicly available to really help level set and say, is that realistic across all suppliers? Or, is that just something that was demanded, but they didn't really realize the value of that? So we could look at some of this information and really see that performance against our peers in the industry and really help the organization set the target and set a realistic target of what we could capture.
That brings us to our next poll question, which is about to be displayed on your screen. This time we want to know, does your organization currently have clear access to its working capital performance data and key performance indicators? Does your organization currently have access to its working capital performance data and key performance indicators? Yes, no, but you're planning to change that. No, and you have no plans to change that, or you're not so sure. Take a moment to respond to the poll question now displayed on your screen, and we'll discuss the results in just a moment. All right, Adam, so we'll put you on the spot. In most of the finance departments that you walk into, do you find that the organization has clear access to the types of working capital performance data and KPIs that you've been talking about today?
Yeah, I think it's, a little bit of a mixed bag, but you'd be surprised by, some of the organizations and, the size of the organizations that, are, upfront with saying that, they don't have, that clear access. And, when you look at, some of these, competing, things within an organization and within, the IT department, sometimes it's hard to get, prioritized to, look into this. And that's something that we see a lot of times is that we know we have the data because we're giving you the data for the services you provide, but for us to get the opportunity to have our IT department prioritize our needs is sometimes the biggest issue that they have is getting that right availability of time from another department to provide them the information they need to help manage the business and make some of these decisions.
What's the single most important thing that someone listening in today can do after the webinar to start on the way to having the type of visibility that you've been describing today?
Yeah, I think, the main thing is, just knowing where are you at today, as an organization. It's really hard to say, hey, let's go out and improve our working capital when you don't know that baseline of where you started. And I think, that's kind of, the starting point is, whether, it's at a, total company view or at a more granular view, just having some level of baseline to see where are we at today, and is there a realistic opportunity for us to improve. I think having that baseline is the first step of really evaluating what you can do within the organization.
Let's see how our attendees responded to our poll question. We asked you, does your organization currently have clear access to its working capital performance data and key performance indicators? 52% of you believe you do. 13% of you say you don't, but you plan to do something about it. 6% of you say you don't, and you've got no plans to do anything about it. And 30% of you aren't so sure. Perhaps you don't know if you measure up to the standards that Adam's been describing today, and that's okay. And that brings us to one last poll question, which is about to be displayed on your screen. This time we want to know, does your organization currently have access to internal and external working capital benchmarking data? Does your organization currently have access to internal and external working capital benchmarking data? Yes, no, but you're planning to change that. No, and you've got no plans to change that, or you're not sure. Take a moment to respond to the poll question now displayed on your screen, and we're going to discuss the results in just a moment. How valuable is this external working capital benchmarking data in the scheme of things, Adam?
I think it's something that we get a lot of questions about, just because it is something that is new, and we see it whether it's on a personal level, as we look at Glassdoor and look at what is the pay for my position, and there's a lot of benchmarking that we do in our normal lives, so it's just kind of a natural position to see what is somebody else getting. And I think that's where some of this becomes valuable, is to really just give another data point to help set what should we be doing, and really bringing in some of the expertise and experience that others in the market have gained, and bringing that into our organization that may not have had that experience. So that's where we see value there.
We asked our attendees, does your organization currently have clear access to internal and external working capital benchmarking data? Here, once again, 54% of our attendees believe they do have access to the type of benchmarking data that you're describing. 10% of our attendees say they don't, but they plan to do something about that. Another 10% say they don't, they have no plans to do anything about it. And 1/4 of our attendees say they're not so sure. All right, Adam, so what's the key message that you want to deliver to our attendees today?
Yeah, I think if your organization is looking, and from the polling results, it looks like a lot of them are looking to do some working capital improvement. It's really bringing all that information together to help you manage where your opportunity is and how you're going to go out there and capture it, whether it's through the inventory or the accounts payable or your accounts receivable. It's really having that strategic strategy around each of those components, and that responsibility of how are we going to go out there and capturing that. We see a lot of organizations, they bring in an external partner to help support them, to really help bring in some of the expertise that is out there in the market. Like, a lot of times payment terms are not part of an everyday negotiation. It's something that becomes an evergreen part of a long-term contract or agreement. So we don't see that being a focus of negotiations and a lot of ongoing renewals. And so bringing in some of the expertise to have like a whether it's to help build out a strategic program, or just to help provide data and playbooks to bring that information together. Like, we see a lot of our clients really leveraging external resources to help bring that together to really drive that initiative forward. And then knowing and comparing, like what is really an opportunity, and what are you willing to trade off. Like, we see as an example, when you look at cash discounts compared to, days, like are you as an organization properly, measuring the value of your cash discount compared to what a day is worth? And as an example there, it's like some organizations will, kind of, say, okay, a 1% discount is the equivalent to 30 days. But, realistically, like you should be looking at your cost of capital to really, understand what is that 1% really worth to us? And are we making the right trade-off? As an example, if we were moving from a 1% 30 term to a net 60-day term, is that the right value that we're getting in that? And you're really helping evaluate all the connecting pieces to that answer is really important to make sure that we're not just extending terms, giving up too much of a discount.
And that brings us to the Q&A portion of this webinar. If you haven't already submitted your question for Adam, or if you've thought of another question for Adam, go ahead, use the chat tool on your screen to submit your question to me now. We'll answer as many questions as time allows. Our first question is for Adriana. She wants to know, where can we find the public information so that we can do the peer comparison that you're talking about?
Yeah, so when we look at it, a lot of these public sources that we're hitting are for companies that are publicly traded. And so as we look at their financial statements, and there's a number of different places that you could go and find where that data has been extracted and aggregated in a simple to view location, and see some of that. So I know there's a number of providers that provide that information, and then there's just services like Morningstar that you could go out and see some of those KPIs and see the trend over time to really evaluate that. And then when you start looking at the industry, you could start to apply some of that to the companies that are not public, and start to build an industry trend and a little bit of an assumption for the companies that do not have that data publicly available.
Another attendee writes, for corporations with multi-billion dollars in spend, does PRGX outsource the process to get suppliers to new terms, or does it conduct the outreach internally with its own resources?
Yeah, so we don't do the negotiation on our side of it on behalf of our clients. What we do is really help bring the data and the facts together to the best position our clients to make that ask. And so that's where we utilize our solutions to really create that baseline of this is where you started, and using our industry expertise to say this is where we believe you can go with that specific payment term, as an example, based on our experience in the market and what we see based on the data.
Another attendee wants to know, how is the industry evaluating cash discount versus due days?
Yeah, it really becomes back to like what I mentioned before around like your specific cost of capital. Like we've seen instances with some of our clients where they've really shortchanged themselves because they extended a term and gave up the discount. And so I think it's really important to evaluate what is a 1% discount or a 2% discount really worth to your organization based on your cost of capital. And the higher your cost of capital, the less that discount is worth. And so like when we see some larger organizations that have a very low cost of capital, that 1% might be equivalent to 45 days. Versus if we were looking at an organization that had a really high cost of capital, it might be closer to 30 to 20 days. And so that's something that we help with our clients set that mark to say, okay, this is what your cost of capital is, and if you are going to negotiate, like have that modeling ability to really evaluate, are we really capturing the most value with that term, or are we giving up some of our value by not taking the right cash discount and day mix.
Another attendee wants to know, are organizations having any success implementing a specific payment term, such as net 90 days across all suppliers?
Yeah, we've seen some depends on the industry how much success there is with that. Really when it comes down to it, like it's not a one size fits all from a payment term, just because of the, different industries that, a company might play in. Just using, grocery as an example, when you look at fresh meat that has a 7-day shelf life, you're not likely to, convince that supplier to, move to a 90-day payment term because the product life is so short. And so that's where, the industry is really, important to, help evaluate that and not try to go after suppliers that there's no, history or no precedent of getting that type of term in that industry. So that's where I think, having that overall market evaluation of, where does that category really perform in the market and what should we be going after really helps streamline the opportunity and really, narrows it down to what is realistic and what's not realistic in that process.
And that will be our final word. Adam, thanks so much for an excellent presentation and for sharing your insights with us today. And thank all of you for taking time out of your busy days to join us. And with that, I'm going to hand it back to Jovi, Ms. Jovi.
Thank you, Mark. That's all the time we have for today's program. I just have a few quick housekeeping notes to go over before we officially close out. If you could please fill out the short evaluation form that will appear once you close the webinar, this will better help us serve your needs in future webinars. And as a reminder, the on-demand materials will be emailed to everyone within 2 business days. This will include a PDF of the slides as well as a link to the recording of today's presentation. Thank you again to Mark and Adam for a great presentation today, and thank you to all of our attendees for taking the time out of your busy days to join us. This webinar is brought to you by IOFM and sponsored by PRGX. Thank you all and have a great day.